Somebody online just told you that half their rent is a business write-off. And honestly, it sounds so good, you almost forgave them for the ring light in every shot. But before you start filming your kitchen and calling it a headquarters, we need to talk about what the IRS actually thinks of that plan. The strategy sounds like this. You rent an apartment for $6,500 a month, you record content there, you meet a client or two, you Airbnb it when you leave for vacation, and suddenly half your rent is a deduction. It's the kind of math that feels genius at 2 in the morning and felonious by noon. Here's the rule that blows the whole thing up and is only 3 words long. Exclusive use required. The IRS says that to deduct any portion of your home as an office, that space must be used regularly and exclusively for business. Not sometimes, not mostly, exclusively. That living room where you film your content is also where you eat cereal and watch reality television, and the IRS does not consider those equivalent activities. The moment personal use enters the picture, the deduction can be disallowed in an audit. But I also recorded a podcast in here is not a legal defense. Now layer in the Airbnb angle, because this is where it gets almost comedic in its complexity. If you use the property personally for more than 14 days in a year, or more than 10% of the days it's rented out, you've triggered what's called the vacation home rules, and those limit or eliminate key rental deductions. So let's follow the math on this free apartment together. You're personally living there, personally cooking there, personally sleeping there, and then renting it out on weekends. You have now managed to disqualify yourself from both the home office deduction and the full rental deduction simultaneously, which is genuinely impressive in the worst possible way. The content creator who built this strategy around a clever edit sequence didn't invent a loophole. They invented a liability with good lighting. The IRS doesn't subscribe to your channel, they don't care about your engagement rate, and they are not impressed by the transition effects. What actually works here isn't a hack, it's just proper planning. And it's almost boring in how straightforward it is. You carve out a dedicated space, a real room, a real office that you use for nothing else. You measure the square footage, you divide it by total square footage, and that percentage becomes your legitimate deduction. If you want rental income to work in your favor, you track every night the property is rented versus every night it's personally occupied, and you keep that personal use under the 14-day threshold. Boring records, real results, no drama with federal agencies. Historically, the people who get hit hardest by these audits aren't the ones who cheated recklessly. They're the ones who read a creative interpretation of the tax code and assumed creativity was the same thing as compliance. The IRS has seen every version of this story, and they have a dedicated section of the tax code for each one. The misconception worth correcting is that aggressive tax strategy means finding the cleverest angle. Real tax strategy means applying the actual law, the actual court cases, and the actual regulations to your actual facts, and then documenting everything like someone is going to question it, because someone might. Position size matters here too. The risk you take with a shaky deduction should never outweigh the tax you'd save by just doing it right. Discipline in tax planning looks exactly like discipline in investing. Unemotional, process-driven, and deeply unimpressed by viral strategies. The people who build real wealth through real estate and business ownership aren't the ones finding loopholes. They're the ones building systems that hold up to scrutiny year after year. There's something almost philosophical about the fact that the free apartment strategy fails precisely because the person tried to have it all at once. Personal space, business deduction, rental income, and zero trade-offs. You can have most of those things, just not all of them simultaneously without a plan that actually maps to the law. At the end of the day, the IRS doesn't care how clever your content is. They care whether your deductions are defensible, your records are real, and your use of the property matches what you claimed on your return. Compliance isn't the enemy of wealth building, it's the foundation it sits on. If any of this has you thinking about how to structure your next property, your home office, or your short-term rental the right way, check out our links in the description below. We can help you get started, whether you're looking at real estate investing, home contracting work, or finding the right lenders.